The U.S. hits China with a 245% tariff, Beijing strikes back, Trump claims prices are falling, and New York's Attorney General faces a mortgage fraud probe. Where will this trade standoff lead? Toward negotiation or escalation, just months before the election. On April 17, 2025, former President Donald Trump announced a 245% tariff on Chinese imports, pressuring Beijing to appoint an official trade representative and return to the negotiating table. The move is aimed at securing more favorable terms for U.S. trade and curbing what Trump described as unfair economic practices by China. If talks proceed successfully, stabilized prices on Chinese consumer goods, such as clothing, electronics, and household items, could relieve pressure on U.S. households. Currently, steep tariffs have raised costs across the board, directly impacting American consumers' daily expenses. Experts suggest millions of American families could benefit from more balanced trade terms, easing inflation concerns and improving domestic economic stability. Before signaling openness to talks, China launched significant retaliatory measures. Beijing canceled all pending aircraft orders with Boeing and banned the purchase of U.S. planes and aerospace components. More critically, China suspended exports of 6 key rare earth minerals, essential to U.S. defense and high-tech industries. This rare earth embargo poses a serious threat to American manufacturing supply chains, particularly in electric vehicles, smartphones, computers, and weapons systems. If prolonged, the move could drive up production costs, leading to higher retail prices and impacting both consumers and workers in affected industries. Following April 5th remarks, Trump claimed that prices on gasoline, food, and mortgage rates have declined. He also said tariff revenue is pouring in and fueling the U.S. economy. However, Treasury Department data shows daily tariff revenue averaged just $259 million in February and $263 million in March, well below Trump's claim of $2 billion a day. Meanwhile, housing supply has reached a 15-year high, with over 500,000 newly listed homes across the country. The surge in supply may help ease housing prices, providing more opportunities for working families and first-time buyers. Still, some economists warn the trend may be temporary and not reflective of long-term market shifts. According to a recent University of Massachusetts Amherst poll, just 2% of Trump voters say they would change their vote if given another chance, down from 3.5% in 2017. This signals strong loyalty among Trump's base and suggests he could maintain significant grassroots support heading into the 2024 election. Such unwavering backing could shape U.S. policy direction on trade, taxes, and immigration. If Trump returns to office, potentially leading to extended tariffs, tighter immigration controls, and a more inward-looking economic strategy, directly affecting jobs and consumer prices. New York Attorney General Letitia James, known for high-profile lawsuits against Trump, is now under federal investigation for alleged mortgage fraud. Reports claim she misrepresented her primary residence and marital status to obtain financial benefits, potentially violating federal lending laws. If the allegations are confirmed, the case could undermine public trust in the justice system and raise concerns over whether powerful figures are exploiting financial systems that everyday Americans increasingly struggle to access, especially in securing home loans amid high interest rates and strict lending standards. The United States has imposed record-high tariffs on Chinese goods, but the question remains, which side stands to lose more? While China responds with currency devaluation and redirects its exports, the world now faces the risk of deepening divisions. In the first quarter of 2025, the administration of President Trump imposed record-high tariffs, with some products reaching as high as 145% on imports from China, aiming to reduce dependency and pressure Beijing to make concessions on trade and technology. According to AP News, However, but as import costs rose rapidly, many small American businesses were forced to raise prices, cut staff, or withdraw from the market. A retail company in California reported having to pay nearly $630,000 more per year due to the new tariffs. A coffee machine that used to cost $120 has now risen to over $180. This has caused consumers to become more cautious in their daily spending. The ripple effect has also placed the Federal Reserve, the Fed, in a difficult position. If it maintains high interest rates to contain inflation, it risks stifling growth. But if it lowers rates to stimulate demand, it puts pressure on the U.S. dollar. By the end of March 2025, the Consumer Price Index, the CPI, had risen by 4.2% compared to the same period last year, the highest in 18 months. In this context, households with young children or elderly members are especially affected, as healthcare and food costs have surged. Immediately following the United States' decision to raise tariffs on Chinese goods to as high as 145%, Beijing allowed the renminbi to depreciate significantly. This devaluation made Chinese exports more affordable in global markets. According to a report from Bloomberg, in April 2025, the RMB-USD exchange rate dropped to 7.4290, the weakest level since 2010. However, Chinese consumers are now experiencing price increases of 10 to 20% on imported goods compared to the beginning of the year. Many households have begun to shift their preference toward domestic products. At the same time, China swiftly restructured its export strategy, redirecting a large share toward ASEAN and Europe. According to Global Times, in the first quarter of 2025, exports to ASEAN rose by 20.3%, especially in categories such as lithium batteries, auto parts, and consumer electronics. As for Europe, the World Trade Organization, the WTO, projects that Chinese exports to the region could increase by an additional 4 to 9% in 2025. One outcome of this shift is that many Chinese workers are now required to retrain and acquire new skills in order to adapt to changes in production lines, which may temporarily disrupt their incomes. According to AP News, in the first quarter of 2025, China's GDP grew by 5.4%, exceeding the projected 5.1%, largely due to a surge in exports prior to the implementation of new U.S. tariffs. Nevertheless, falling real estate prices and a 9.9% decline in property sector investment have raised concerns among many households. Asset values have dropped, and low inflation has contributed to a slowdown in the domestic consumption, although exports increased by 6.9%, enabling China to post a trade surplus of 1.96 trillion yuan in the first quarter. A 6% drop in imports has led many families to reduce their purchases of imported goods. In April 2025, the U.S. dollar fell nearly 10% from its peak earlier in the year, marking its sharpest decline since 2022. The USD index dropped below the 100-point threshold, reflecting a weakening of global confidence in the dollar. Prices for imported goods, such as electronics and food, have risen. In addition, interest rates on home and consumer loans have also increased, making everyday living costs more burdensome. President Trump's trade and diplomatic policies are contributing to a growing divide between the United States. China unexpectedly halts U.S. beef imports, disrupting $2.5 billion in exports. What's behind the move, and who stands to lose? As of March 16, 2025, China has not renewed import permits for over 300 U.S. beef processing facilities, rendering a significant portion of American beef exports ineligible for entry into the Chinese market. This move follows the United States' decision to impose a 25% tariff on Chinese electric vehicles and related components, and is widely seen as part of Beijing's broader trade response. According to U.S. government data, beef exports to China plunged from an average of 2,000 metric tons per week to just 54 tons in the week ending March 20. China has also imposed additional tariffs of 10% to 15% on U.S. agricultural products, including beef, making American goods less competitive in the Chinese market. In 2024, the U.S. posted a record $8.63 billion in pork exports, with total volume reaching 3.03 million tons. Beef exports contributed $10.5 billion, accounting for roughly 14% of total domestic production. China has played a key role in this growth, representing 14% of U.S. beef export volume and 15% in value, along with 15% of pork volume and 13% of its value. Since March 2025, however, China has levied steep tariffs, 56% on U.S. beef and 81% on pork, further eroding the competitiveness of American meat products and triggering a sharp decline in exports to this vital market. As a result, surplus supply is building up domestically, putting downward pressure on prices. According to the U.S. Department of Agriculture, USDA, wholesale beef prices fell 1.9% in February 2025, while pork prices dropped 6.2% in January, before rebounding 7.9% the following month. While the price decline may benefit American consumers in the short term, with more affordable meat at the grocery store, long-term disruptions in export channels could reduce farm incomes, affect employment in food processing, and impact related agricultural commodities, such as corn and soybeans. In the wake of China's higher tariffs on U.S. beef and pork, Russia has seized the opportunity to strengthen its presence in the Chinese market. Sergei Dankvert, head of Russia's Federal Service for Veterinary and Phytosanitary Surveillance, Roslkoznadzor, stated that Russian meat exports are expected to reach 1 million tons in 2025, up from 860,000 tons in 2024. China, the world's largest consumer and importer of beef, brought in a record 2.87 million tons in 2024. Russia's pricing and quality advantages are positioning it as a key alternative supplier. The expansion of Russian meat exports may also help stabilize domestic Chinese meat prices, especially as beef prices fell by 22% in 2024 due to oversupply. Rising beef imports in China reflect increasing consumer demand, driven by higher incomes and a growing preference for premium meat products. To reduce dependency on a limited number of suppliers, China has broadened the list of approved beef exporters. Recent policy changes have allowed more producers from Australia and Russia to enter the market, while easing restrictions on German beef. Other key suppliers include Brazil, Argentina, Uruguay, Belarus, and Chile. For Chinese consumers, this diversification helps ensure supply stability and price consistency, meeting the country's growing demand for beef. For the U.S., however, China's strategic pivot in sourcing could lead to prolonged oversupply in the domestic beef market, with potential implications for pricing and agricultural sector stability. China is responding strongly to the wave of tariffs imposed by the United States, with actions that could reshape the global trade landscape. How long will this confrontation last? And how will the everyday lives of citizens in both countries be affected? In 2025, the administration of President Trump imposed tariffs of up to 145% on Chinese goods, comprising a 125% retaliatory duty in response to subsidies and an additional 20% related to fentanyl, a substance linked to over 80,000 deaths annually in the United States, according to Reuters. The steep tariffs have significantly raised the prices of Chinese goods in the U.S. A laptop that once cost $600 may now exceed $1,000. Consumers are having to spend more, particularly on electronics, kitchenware, and clothing. Small businesses are also facing challenges due to higher input costs. At the same time, the U.S. is negotiating with more than 70 countries to prevent China from using transshipment routes to circumvent the tariffs. This effort has led to a drop in orders for many Chinese export factories. In Guangdong, certain areas have reduced working hours, affecting the incomes of millions of workers. Nevertheless, President Trump remains optimistic that an agreement can be reached within weeks. In the meantime, people in both countries are feeling the impact, reflected in everything from shopping bills to monthly wages. China remains firmly unyielding in trade negotiations with the United States, primarily due to its Made in China 2025 strategy, an industrial upgrade initiative aimed at establishing leadership in critical sectors such as artificial intelligence, robotics, semiconductors, electric vehicles, and healthcare. This program is supported by substantial state subsidies and preferential policies, raising concerns among the United States and other Western nations regarding potential unfair competition and the risk of losing technological preeminence. To pursue this objective, China has invested heavily in research and development, R&D. In 2024, the country's R&D spending reached 3.61 trillion yuan, approximately USD 497 billion, accounting for 2.68% of its GDP, an increase of 8.3% compared to the previous year. This level of investment has enhanced China's innovation capabilities and brought it closer to the status of more advanced economies. Additionally, China plays a pivotal role in the global supply chain. The nation supplies over 80% of the world's electronic components, 70% of medical devices, and 60% of pharmaceutical ingredients. This level of dependency makes it significantly challenging and costly for businesses and consumers worldwide to replace Chinese sources. Given such technological positioning and supply chain influence, China has strong motivation to maintain a firm stance in trade negotiations, aiming to safeguard its strategic interests and avoid being subjected to potentially unfavorable terms. China has imposed retaliatory tariffs of up to 125% in response, restricted rare earth exports, and launched anti-monopoly investigations targeting U.S. companies. However, these actions are unlikely to offset the losses stemming from reduced access to the U.S. market, a major destination for Chinese exports. In the first quarter of 2025, China's GDP grew by 5.4%, bolstered by a surge in exports ahead of the implementation of new U.S. tariffs. Yet, projections suggest that full-year growth may only reach 4.5%, or even decline to 3.4% should tensions persist, UBS. This situation is increasing pressure on employment and income, particularly in the export sector. The real estate sector continues to weaken. Forecasts indicate home prices could drop by an additional 20 to 25% in 2025, as many households consider real estate a primary form of accumulated wealth. This trend could significantly erode personal asset values. Economic-related protests are on the rise. In the fourth quarter of 2024, the number of such incidents increased by 41% compared to the same period the previous year, largely driven by workers and home buyers protesting delayed wages and postponed project deliveries. In the United States, tariffs have pushed up the prices of Chinese imports. For example, a toaster that once cost $30 now sells for $75. Consumers are feeling the strain on their budgets, and small businesses are grappling with rising input costs. Meanwhile, total bilateral direct investment reached approximately $240 billion by the end of 2023, underscoring deep economic interdependence despite escalating tensions. U.S. China tariff escalation sparks concerns of global economic fragmentation. Trade tensions between the U.S. and China are sharply intensifying, triggering price surges and shaking global financial markets. Is this just the beginning of a deeper economic split? Or could an unexpected turning point help avert a broader crisis? The trade friction between the U.S. and China has been ongoing since 2018-2019, when the U.S. first slapped high tariffs on Chinese goods. Beijing answered with a series of retaliatory moves. Now China's stepping it up, announcing tariffs up to 84% on U.S. imports. No, that hits hard, especially for soybeans, corn, beef, plus tech and machine parts. The U.S. fired back, hiking tariffs on Chinese goods to between 100% and 145%. That means electronics, textiles, auto parts, all getting way more expensive in the U.S. For American exporters, especially those dependent on China, these tariffs could mean serious trouble. We're talking disruptions, or even permanent market loss. Meanwhile, global stock markets, especially in the US and Asia, are sliding. Why? Because investors are worried about supply chains breaking down and what this could mean for the future of global growth. According to estimates from the Peterson Institute for International Economics and various independent studies, elevated tariffs could cost American households an additional $3,000 to $5,000 annually, if maintained over time. Recent data from the U.S. Bureau of Labor Statistics, the BLS, indicates that inflation in 2023 ranged from 4% to 6%, based on the Annual Consumer Price Index, the CPI. Additional tariffs could further exacerbate consumer price increases, especially for imported goods such as electronics, clothing, and home appliances. Efforts to shift supply chains away from China to alternative markets like Vietnam or India could raise production costs by approximately 10%. For products requiring specialized components or technology, cost increases could reach up to 40%. If prices continue to rise, purchasing power, especially among middle and lower income households, may be significantly impacted. Amid ongoing trade tensions, yields on U.S. Treasury bonds have surged, with the 30-year yield nearing 5% and the 10-year yield approaching 4.5%. According to data from the U.S. Treasury and Bloomberg, 10-year yields fluctuated between 3.5% and 4.3% in the second half of 2023, showing substantial volatility compared to previous periods of relative stability. Concerns over a prolonged tariff conflict and a broader economic slowdown have led institutional investors and funds to restructure their portfolios. This shift has reduced demand for government bonds. In some cases, market turbulence has triggered margin calls, forcing hedge funds to sell off positions, adding to the chain reaction across global financial markets. China has reportedly reduced its holdings of U.S. Treasury securities to below $750 billion. Despite still being one of America's largest foreign creditors in 2023, China's holdings have shown a steady downward trend in recent months. According to data from the U.S. Treasury, trade-related tensions may be incentivizing Beijing to gradually scale back its exposure to U.S.-denominated assets as a way to reduce economic dependency. A sell-off of treasuries could also serve as a hedge against inflation, against currency volatility, or to strengthen domestic liquidity. Moves like this often shape the strategies of global investment funds and corporations and can increase volatility in both equity and foreign exchange markets. The U.S. is reportedly working to strengthen trade ties with key strategic partners, like Japan, India, and the European Union, in an effort to counterbalance China's growing economic influence. According to the World Trade Organization, the WTO, these alliances already represent a significant share of global trade. But differences in rules of origin, technical standards, and national policy goals are making it difficult to establish unified trade strategies. Tighter trade restrictions on China could eventually lead to a true decoupling of global supply chains, splitting the world into two distinct trade blocs. The G7's partial economic isolation of Russia showed us what that looks like: increased costs, more risk, and ripple effects far beyond just the countries involved. Companies around the world may be forced to restructure supply networks, absorb higher operating costs, and sacrifice flexibility, all in an environment that's becoming more uncertain and more fragmented.